Recording in progress.
Hello, good afternoon, everyone. Want to welcome you all again to Tax Resolution Help Center. My name is May. I'll be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session by the end of this session. I want to congratulate all of you for taking steps to deal with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you're entitled to live a happier, healthier life by keeping more of what you earn and getting the tax man off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes, plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. To better understand what might be on your mind during the session, I might include some polling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, the session will be recorded. The topic for today's session is filing your tax return, dealing with rental properties and Schedule E. The tax expert for today's session is John Shantz. John has the unique perspective of being both a business advisor and business owner. His wide ranging experience can help business owners and employees get through everyone's least favorite topic tax compliance or the repercussions of non compliance. And with that being said, introducing John Shantz.
Thank you, May. Thank you for everybody being here today, and I hope we get you some information you can use. As you know, today we're talking about rental properties and Schedule E. Schedule E is a schedule that's attached to your personal income tax return, which is Form 1040. Quick little bit about me. Again, my name is John Shantz. My email address and telephone number there. If you would like to contact me after this session, if you have any questions, I'd be happy to try to answer them for you. My background is I was in public accounting for a number of years after college, 10, 11 years. Ran my own home building company for almost 30 years, successfully retired from that. And now I keep myself busy with some more tax and accounting work. When I'm not doing that, having fun working, I'd rather be skiing. That's my big thing. I hope you all have something you enjoy doing as well. So what we want to cover today, this is going to be kind of a broad brush top overview coverage of rental properties and Schedule E. We're going to talk about rental real estate. What is Schedule E? We'll talk about basis. That's the cost of your property, depreciation, capital improvements versus repairs and maintenance, and touch on passive loss rules as well. So that's a lot to cover in a short period of time. I want to give you plenty of time to answer questions. And again, I'm not going to just a kind of a broad brush review of these issues. Rental real estate. Why own rental real estate? Leverage. You can control a large asset with a small down payment. The leverage being the mortgage. So you might mortgage $200,000 property with a $180,000 loan and $20,000 cash down. That kind of keeps your initial investment low. Another great advantage of rental real estate is cash flow versus taxable income. You can cash flow, have positive cash coming in your pocket while having taxable losses, or at least taxable income lower than the cash that's coming in. You may be aware, different types of rental properties out there: house hacking, sharing a house with somebody, vacation homes, Airbnbs, VRBO, residential and commercial rental property. Schedule E. What is Schedule E? Schedule E is part of Form 1040, and that's where you report your income and losses from rental real estate. It also is a place where you record income from partnerships, S corporations, estates, and trusts. We're not going to get into those today. We're just talking about rental real estate. Let's take a look at Schedule E. Some information here you need to check off when you go through doing Schedule E. If you own rental real estate, you need to check off this box here if you're required to send 1099s to anybody. If you hired contractors and paid them more than $600, you may be required to file 1099s for the work that was done. The type of rental property that you have, single family, multifamily, vacation, etc. You need to report the number of fair days rental, which is fair market rental. You're required to rent your property at fair market value. If you don't, you may have some limitations on your income and deductions. You need to report if there's any personal use days as well. And then the meat of Schedule E is right down here, reporting your income and associated expenses with that rental property. The different columns are for each separate rental property. So let's talk about basis a little bit. Basis is the investment in your property for tax purposes. It's basically what you paid for it, your cost. So if you bought a rental unit for a couple $100,000, that's your basis plus any settlement costs to buy that property. You may have some legal fees, title searches, things like that would go into the cost basis of your property. The adjusted basis of the property is something you need to know if you go to sell the property. Adjusted basis means your original costs plus any improvements you made to the property. If you did an addition, you rehab the property, that's going to go into the cost of the property. And then you would subtract any accumulated depreciation. And we'll talk about depreciation a little bit more here in a minute. There are some assets that versus the building. So if you get a $200,000 property, you need to figure out how much of that purchase price is attributable to land. There are a number of ways to get to that and estimate what the land value is. And we need to know that because land can't be depreciated. About how to break out that cost between land and building, wrote in the chat. Be happy to try to answer that for you. It can get a little bit detailed. So let's talk about depreciation. Depreciation is one of the big advantages of real estate. It gives you a taxable deduction that you can reduce your rental income by without really costing you cash out the door. You have the initial investment in the property, kind of an easy way to look at depreciation is you can't write off that initial investment in the year you buy the property. You have to write it off over, in the case of residential real estate, 27 and a half years. So if you had a $275,000 cost of the property, we'll just, for this example, say it's all, there's zero land. Not realistic example, but it's $275,000 cost. You get to write 27,000. Did I do that right? 275,000. You get 27. I'm doing this wrong. I apologize. $2,750 a year of depreciation you get to write off annually against your rental income. One of the biggest problems with rental real estate what you paid for it, because that would be the correct amount. You're going to have a bigger gain to report without having the advantage of taking those deductions over the years that you own the property. So you really want to be careful. You really want to make sure you take depreciation. If you own a rental property and you're looking at yourself and saying, I never took depreciation, there are ways to fix it. You can file an amended return, and you can file for a change in accounting methods. So there are ways to catch up and fix that error. Obviously, it's best if you can get it right off the bat. Another big area when it comes to rental real estate is capital improvements versus repairs and maintenance. Repairs and maintenance give you a current deduction. You fix a leak in the roof, you get to write that expense off in the year that you paid for it. So you get a current deduction for that. You replace the whole roof on the house, you're going to need to add that to the basis of the property and depreciate that over a number of years. So if you're doing work on the property, you need to determine what's repairs and maintenance and what is a capital improvement. Generally, capital improvements improve the property, result in a betterment of the unit. So rehabbing the house is going to be a capital improvement. If you got to paint a room, that's typically a repair maintenance. And you can write it off right then and there that year. Income and expenses. So once you have the basis, you get your depreciation figured, then it comes down to the actual income and expenses of owning that property. Your income are your rents. All rents are considered income in the year they're received. And then from an expense side, ordinary and necessary business expenses are deductible. So in a piece of rental property, you got utilities. You might have lawn care. Those are some of the big ones. You got property taxes, interest on your mortgage, all deductible on an annual basis when you pay for them. You're going to want to keep good records, obviously. Us accountants, we get pretty picky about trying to keep good records. I know some people have a tough time with it. One of the easiest ways to keep track of everything is just have a separate bank account. You own a piece of rental property, put the income